Now that we've discussed valuing the portfolio insurance strategy, we're going to look at some other strategies for options that can be used if investors want to make certain bets on the way the stock price will move in the future before the expiration date of the options. So we'll look here at something called a BullSpread strategy. So the BullSpread strategy is a strategy that gives a certain payoff if the stock price increases over a certain amount. And so what we would do with the BullSpread strategy is we would buy a call option, and then we would sell a call option with a somewhat higher price. And so in this case, what we'll do, we've got here a call option on SPY that's at 380, and that had a market price of $20.18. And so we're going to look at another option. Let's suppose we look at the one that has a strike price at 400. If we go over to the options prices and go down, we'll see that the market price of the option that has a strike of 400, the call option, is 1172. So we're going to note that over here. That the market price is 1172. Okay. Now, the best thing to do in this case, if we're going to look at these other option strategies, is to just go ahead and simulate the price as if it's the actual price of the stock or mutual fund in this case that we're going to observe. So if we look at this formula for the risk neutral price, the only adjustment we need to make to this to simulate the actual price that we expect to observe in the market is to replace the risk-free rate, which is B3 right here, with mu hat, which is up here on row 1. So I'm just going to copy all of this formula, highlighted it and used Control-C, and then paste it down here in this cell where we have actual price, and then going to adjust one thing, and that is we're going to change the rate this stock is simulated when it grows to B1, which is the mu hat that we estimated for the geometric Brownian motion. And that's the only change we need. I'm going to make this an output in at risk because eventually we're going to want to output this information into Excel from the simulation. Okay, so let's simulate the BullSpread. All right, so here is the way we would simulate the BullSpread payoff. The BullSpread assumes that we buy a call option on the SPY mutual fund, and we'll buy one relatively close to the current price. So in this case, let's just use the call option that we already have valued here. And the call option payoff will be the future stock price. We're going to use the actual price minus the strike price of 480. Now, anytime we value the option, we discount it at the risk-free rate for the time to expiration of the option. So this is the payoff of the call option. And the one difference from what we did previously is we're just going to simulate the actual price we expect to observe and then discount it. Now, if we're going to buy this option, we need to subtract out the market price that we would have to pay. and that is 2018. Okay, now the second part of this strategy is that we're going to sell a call option that has a somewhat higher strike price than the other option that we just used. So if we're going to sell an option, we're going to receive the market price for the option. So we'll go ahead and use this call option that has a strike price of 400. Now, we don't have to use this strategy. We don't have to own this option to be able to sell it. Brokers can help conduct this transaction. But the effect is that we would receive the price, and because we're selling the option, we would pay, so we would subtract the payoff of the option. So that'll be the actual price minus the strike price. Now, the strike price of the second option that we're considering here is 400. And then because this payoff occurs in the future, we would discount it at the discount rate, which is the exponential function, negative the risk-free rate times the time to expiration. It's a fairly complicated formula, but what we have here is the payoff of the first call minus the price of the first call, because that's what we're purchasing, plus the price of the second call, because we're selling it, we receive that price, minus the payoff from the second call. And we call that a bull spread. And so we'll make this output called BullSpread. All right, so here's what we need to do in terms of simulating this option. Let's simulate this. And we can see what happens with the BullSpread. The BullSpread has a mean that's really very close to 0. But the minimum payoff is a loss of 8.46, whereas we stand to gain in some cases 11.19. Now, with the bull spread, we're making a bet that this price increases in value for SPY. So what would be helpful is to do an overlay and then extract some of the data and see if we can create a graph that helps us to understand the payoff of this strategy. So let's create an overlay. And the two things that we're going to overlay are the actual price of the SPY and the bull spread payoff. Okay, now in this particular case, the window here may not be terribly helpful, but what we're going to do is we're going to go down here to the export data, and we're going to export to Excel. I'll go ahead and select New Worksheet in Active Workbook. All right, so when we do that, what we have is two columns here. In some ways, it'd be nice to have the bull spread payoff to the right. So let's just copy column C and copy it over in column E. Okay. Now, we're going to highlight all of this data here. And this was doing 1,000 iterations. And we're going to go to data and sort this. And so we're going to sort this by, we're going to choose in my case, I did not highlight any headers. So we're just going to sort this by column D. And column D is the actual stock prices that were simulated. Okay. So now we have here actual price, and we have the BullSpread output or the BullSpread payoff. So let's highlight all of these values, and we're going to create an XY scatter plot that illustrates the payoff of the BullSpread. So with all that highlighted, I'm going to go to Insert, and then this is the scatter plots. And we'll choose either one of these. We'll go ahead and choose this one. And so what we see here is the payoff profile for the BullSpread. Now, it's an interesting graph. It says that basically right here, we see that that point is right about 380, which is the strike price of the first option. So if the current stock price, as we simulate it, goes below 380, we simply lock in a loss that's about 846. We can't lose any more in this case than 846. If the stock price rises above the strike price of the second option, the one we sold, then we lock in this payoff. And that payoff is a little bit over $11, about $11.19, we can see over here in the data. And so if we want to make a bet that SPY will go up, but we want to limit our loss, the BullSpread is a way to do that. And if you look at the cost of it, the cost of doing this was fairly small. So if you think about it, we purchased an option for, in this case, 2018, but we sold an option for 1172. So really the cost of this strategy is 846. And you can see that that's the limit of our loss. If we want to make a bet and buy an individual share, of course, of SPY, it costs $363.38. And so that's much more expensive than setting up this BullSpread. Now, of course, the disadvantage is we cap our upside gain at the value here, which is about 1119. But it was much more cost effective to make that investment than buy the actual SPY shares. So that is an illustration of the BullSpread.